Hi, this is Elliot Eisenberg of Graphs and Laughs, here to catch you up to date on the latest in residential sales data for Hillsborough County. And in Hillsborough County, prices have dropped just a little bit, almost 2% on the single-fam side and 0.5% on the multi-fam side. If you look at sales activity, it's down in both sectors, 14.2% on the single and 12% on the multi. And if you look at pending sales, they're down 5.8 on the single-fam side and a little bit less, 2.8 on the multifam side. So multifam is performing a little bit better than single fam. There's no question. Inventory is down a whopping 24% on the single fam side, but up 7.5% on the multifam side, maybe attracting people to multifam because there's more of it to look at. Last but not least, the sales price as a percentage of list price fell on both single fam and multi, from 100% in both cases down to 98.8 in the single fam side and 98.3 on the multi-fam side. Looking at Pasco County, sales prices didn't do anything. Single fam prices were completely flat, and multifam prices went up 0.2 of a point year over year. Nothing very interesting on that score. On sales activity, it declined a smidge, 0.2 of a point for single fam, but went up a strong 19.7% on multifamily. And on pending sales, they fell 1.9 on single family, but went up another strong 11.3% on multi. Multifam is clearly doing really well, in part because inventory's up. Inventory's up 28.5% on the multifam side and down 17.1 on the single. People may be looking at multifamily like they are in other counties because single fam is so hard to find. Last but not least, the sales price as a function of the list price fell in both types of properties from 100% to 98.7, a sign of a slightly weakening market. Turning our attention to Pinellas County, single-fam home prices went up a very strong 6.8%, the best price performance across all three counties for both types of properties. Multifam prices didn't go anywhere. They're exactly the same as they were a year ago. Sales activity went up a nice pleasant 4.3% on the single-fam side and down just a smidge at minus 2.8 on the multifam side. In terms of pending sales, on the single fam side, down 5.9, but up 5% on the multi-fam side. And that may be because of inventories. Inventories shrank 23.5% on the single fam side, but went up a little over 50% on the multi-fam side. Across all three counties, single fam inventories have been falling, while multifamily inventories have been rising. Last but not least, the percentage of sale price received as a function of the list price declined on both sectors here. On the single fam side, falling from 99.4 to 98.5, and on the multifam side falling from 100 to 94.9. Turning our attention to the national economy, GDP continues to be strong. Q2 GDP was above trend growth. Q3 looks to be above trend growth. And while that's terrific on one hand, good job growth, lots of GDP, higher incomes and so on, it's causing the Fed fits. It's causing the Fed fits because the growth is above trend, as I mentioned earlier. And that means our economy is growing faster than it could. And the fear is that's going to keep inflation higher than it otherwise would be. Yes, inflation's fallen from 9.1% about a year ago down to 3% today, roughly. But the problem is the decline has come in the wrong areas of inflation. It's come in food, energy, transportation, goods, and housing. And those are sectors that the Fed feels, I think to some extent rightly so, that they went up because of COVID, and now they're coming down because of COVID, and therefore they can be ignored. The Fed instead looks at core inflation, which is running almost at 5%, and core services, which is running at 5.5%. And as long as those numbers, core numbers and core services numbers, are in the 5 range, they've got to get a 2 handle on them before the Fed feels comfortable enough to begin thinking about lowering interest rates. As a matter of fact, the Fed is now dangling the possibility, or continues to dangle the possibility, of raising interest rates by a 1/4 point, not at their next meeting in September, but the meeting essentially after that ends on November 1st, in an effort to slow the economy down and, importantly, lower wage inflation and increase unemployment so the economy slows and inflation goes away. Unfortunately, the combination of a good economy now, the potential for higher rates down the road in November, and the likelihood that the Fed's going to keep rates at this high level for some period of time has caused interest rates to rise and the 30-year mortgage rate to go with it. That certainly is problematic for housing and a lot of other sectors, and the Fed knows it. That said, there's no relief in sight. There's no pivot towards low interest rates until certainly next year. Now, I expect interest rates to fall next year, but unfortunately, it's not going to happen now. The big thing to pay attention with is how long the Fed keeps rates up at this level. If they bring them down, say in January, okay, maybe we skirt the recession. But if they keep them up through June or July or August of next year, that's an entirely different story.